Well, hey there, everyone. Welcome to Chart This with Dave Keller and happy Monday. Hope you guys had a great weekend. Uh, Keller family enjoyed a little Seattle Mariners baseball, including a walk-off home run in the bottom of the ninth by JP Crawford, which was fantastic. Watched some Sounders on Sunday. Did some blueberry picking on Saturday. Pretty decent weekend, I would say, all around. Hope you guys took some time to renew, reflect, recharge, all the R's over the course of the weekend. We, for my market misbehavior premium members over the weekend, we talked about the carnage that Friday had unleashed in terms of the weakness that we saw going into Friday's close, some of the evidence we would need to see this week to either determine a short-term tactical bounce or the beginning of a much more deeper and more painful, more protracted bearish phase. In a lot of ways, it's hard to tell that in the course of the initial drop because those things look kind of the same at the beginning. It's all about what happens in the days to come, how we relate to key levels of support, what happens with volume, momentum, breadth, all the conditions that we love to talk about through the course of this show. So we'll talk about what happened today, which was a beautiful counter trend bounce after the weekend weakness that we saw Thursday into Friday. A nice bounce to the upside with the S&P almost getting back to 6330, which is an impressive run on the day. Is that enough to change this back to a raging bull market again? I don't think so, would be my general sort of short answer. The long answer, let's talk about here on the show. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. As always, none of this is a recommendation to do anything in your portfolio. It is for educational purposes only. My goal is to make you think, to entertain a little bit, but hopefully just to inform and educate, give you the tools and techniques you need to make better decisions in your own investing. And I hope you're able to do that in some small way through our time together. Having said that, let's look at what happened in the markets today. Again, decent update. After Thursday and Friday, we're just incredibly weak. And the jobs data on Friday just really accelerated the market to the downside. However, today, a nice counter trend bounce back to the upside. The S&P 500 finishing the day just slightly below 6330. That's up 1.5% from Friday's close. And as that composite, even better, up about 2%. Mid caps and small caps both up as well. The Dow up, all the US-based indexes here in the green. You can see the VIX, which actually had pushed above 20 on Friday. And that's important. It actually had closed the week just above that 20 level. That's an important kind of back in the envelope level that we always follow, right? VIX below 20 is a low volatility, fairly comfortable, not much to worry about kind of environment. The VIX starts pushing above 20. That's more, we need to start talking about risk management. We need to start thinking about preserving capital as opposed to growing capital. And that's where we were on Friday. Now, today, with the equity markets bouncing back higher, the VIX actually pushing back lower, almost three full VIX points to the downside, ended the day around 1750. So I think what happens over the next couple sessions with the VIX, pretty important. VIX pops above 20 through the remainder of this week. That would be a big time red flag for now, moving lower. So the volatility of the volatility, and there is a ticker for the VIX of the VIX. The CBOE actually releases that. I think on stock charts, it's $ VVIX, I want to say. Yeah, the VIX of the VIX is popping up pretty good here because the volatility of the volatility is moving very, very quickly. So we'll keep in mind, obviously, VIX above 20, pretty meaningful. We did finish the week above 20 today, back below 20. So let's keep an eye on that and see if the volatility increases. By the way, latest episode of the Market Misbehavior podcast, which is something I started because I love talking to smart people who analyze the markets. Over my career, I've been able to meet a lot of really brilliant strategists and money managers and traders. And I've always been a fan of talking with people whose approaches and skill sets and techniques differ from my own. It's like talking to experts and just getting a sense of what they're seeing and thinking. And then whether or not you believe what they say is true or agree with their conclusions, those conversations always make me think. They help me reinforce my own process. They help me challenge something that I think might work or might not, and just give me a different perspective. The reason why I say all of that is because I interviewed John and Jack Kosar at the end of last week. We just released that episode this morning. John Kosar, I've followed his work for years, used to subscribe to his service when I was at Fidelity. and a fantastic technical analyst, kind of a classic technical analyst, very much like a John Murphy type of analyst, focusing on a lot of indicators. And he runs a series of models, and his son actually helps him run a series of models using technical indicators to gauge broad market conditions, sector rotation, etc. And I asked John toward the end of our interview, you should watch the whole interview, of course, but I asked him at the end, what's the one thing you're looking for that would tell you, things are really starting to get ugly? And he said volatility. Spike in the VIX would be the thing I would be looking for. So with that in mind, keep an eye on the VIX here this week. Rates, a crazy day last week. This is the 30-year yield. You can see how things were fluctuating quite a bit as bonds rallied after the jobs data. Bonds rallying slightly here today. You can see rates came off a bit. The 10-year yield right at 4.2%. The long bond yield is now below 4.8%. So bonds Friday and then today continuing to push higher. Dollar index flat for the day. Not much of a change there. Looking at the commodity space, generally commodities weaker today. Energy in particular looking pretty weak. Crude oil prices down. Natural gas prices down. On the other side, you have metals higher. Copper, which is more of an industrial metal, up about 0.5%. Gold and silver ETFs both up as well. Newmont Mining at the top of the leaderboard today, and gold miners the top performing Dow Industry Group according to my quick look here. So you're seeing some nice moves higher in precious metals today, rotating to the upside along with stocks. Right, both stocks and gold up today. Looking at cryptocurrencies, kind of a sloppy, choppy weekend. Bitcoin did touch 112,000 on Sunday. Today, rallying through the course of the day. Currently, just below 115,000. Ether price is up a lot more. Currently, around 3,700. So while stocks sort of showed some weakness, Ethereum actually rotating back and in a pretty consistent uptrend here over the last 24 hours. You can see that all of the top 10 coins tracked on the stock charts platform in the green. All right, looking elsewhere, technology, communication services, number 1 and number 2 today. They're both up about 2% for the day. This is a big change from the end of last week when the growth sectors were at the bottom of the leaderboard. We had defense at the top, growthy offense at the bottom. Today, that script in some ways flipped with technology and communication services at the top. Now, what was really noteworthy about last week is I was trying to, lick my wounds as an investor and just, trying to gather the evidence over the course of the weekend for my weekly flight plan for my premium members. We talked about some of these rotational elements, some of the signs that we're seeing. And I think the charts of Meta and Microsoft, probably two most important charts last week at the stock level, because these are two companies that had remarkably strong earnings. They are, arguably very good companies with strong growth prospects. Truly dominant in their space, and both gapped higher after their earnings release on Wednesday evening, and both of them traded lower into the end of the week. And for me, good companies with great earnings that gap higher and then start selling off, that tells you that investors are not motivated by rationally looking for good companies growing earnings. They are irrationally panic selling and just getting out of the way because they're nervous about what might come next. And while today was a nice counter trend bounce higher, I think there's more to prove before I would say this is not a fearful market, but I certainly saw signs on Thursday and Friday. That could have been it, and we could just rally from here. I would say a much more likely scenario is August and September are more corrective periods. Now, remember, right? Markets can correct in one of two ways, or both. They can pull back in terms of time. They can pull back in terms of price, right? So it can be a time correction, which is more of a, treading water type of period. They can pull back, right? Which is more of a price correction, or they can do both, right? They can pull back over a period of time and have it be a more protracted decline. And it's not always clear which of those is going to come next, but given the seasonality, given the run we've had, and given what we saw Thursday and Friday, it certainly felt like the beginning of something and not the end of something to me. We'll see what happens. Of course, note, by the way, on the sector side, utilities number 3 from the top, up 1.8%. On the downside, energy weaker. As I mentioned, crude oil prices were lower. So the XLE was down about 0.25%, but that was it. Everything else was up. Consumer staples, real estate rounding out the bottom 3 today. Our market trend model on Friday actually had turned bearish on the short-term time frame on all 3 all four of the major U.S. indexes: large cap, mid cap, small cap, and the NASDAQ. This is showing on stock charts back green because this indicator, this widget on stock charts does a quick check after every close and just sees if there's any changes. So my official kind of reading is bearish short term across the board, given the weakness that we saw on Friday. This model is going to keep checking every day. So this is saying with today's bounce, if today was Friday, the short-term model would indeed turn back positive, and that would be pretty important if today was Friday, but it's not. We got a lot of game left. This is Monday, so let's see what happens through the remainder of this week. All right, breadth data, you can see overwhelmingly positive. This is after some really negative breadth data last week. We've been talking about the weaker short-term breadth and how it was starting to show signs of fatigue in some of the longer-term breadth indicators. Today, a decent update, though. 85% of the S&P stocks were up today, 80% of the New York Composite Index, 71% of the NASDAQ Composite. Those are pretty bullish readings for today. Again, we'll see what happens. One day does not make a trend, so we'll see if that positive breadth continues. One of the themes I've been concerned about as we get to the charts here in a few moments, the breadth data, particularly in the NASDAQ, has not been very good. The bullish percent index in the NASDAQ 100 has gone down quite a bit, actually dipped below 50% last week. So you're seeing some weakness underneath the hood. And so it almost feels like the S&P and the NASDAQ are stronger than the behavior a lot of these stocks would really suggest. I'll show you more what I mean as we get to the charts here. Just to finish off, a quick recap on what happened today on Monday, August 4th. NVIDIA up 3.6%, Meta up 3.5%. I think that Meta chart is so important because, this is a stock that had killer earnings, gapped higher, closed lower into Friday. The question is, do you see further selling? Not today. You actually see a nice bounce. So we'll see which of these forces really dominates through the course of this week. For now, bullish start to the week, and Broadcom and Alphabet both up over 3% as well. Amazon very noticeably down today, down 1.4% today. So, the chart of Amazon, it's not good, right? And I don't think I grabbed this one, so I'll just spend a few moments on it. Here's the problem. Here's the challenge with charts like Amazon that have done so well for so long, right? They're in clear uptrends, and I don't have. Let me bring up the chart with the 21-day EMA on here. Here we go. Firing on all cylinders going into last Friday's session, and they reported earnings Thursday after the close. You have higher highs, higher lows, moving averages in the proper order, strong momentum, strong relative strength. Everything's good. Now, part of the agreement you make when you buy a stock is that you are prepared for earnings risk and company risk and volatility risk and sector risk and all of the risks that are involved with owning an individual stock, right? We have to remember equities are called risk assets. If you've heard me use that phrase many times, that's because what that means is you are taking on risk, right? There's an equity risk premium, which is like this premium that you earn, theoretically by, for owning a stock, which has greater risk than a risk-free asset, right? Than a treasury bond. Treasury bond, arguably very low risk, but relatively low return. Buying individual companies, buying even the S&P 500, but to a greater degree, individual stocks and sectors, you're taking on greater risk because these are risk assets, but you also have the potential for greater return. That's what market history has shown us. And it also means that big gaps lower, like we saw after Amazon is, testing a new 52-week high, and then gaps lower and then continues lower today. That's the risk that this happens. And I don't think that means technical analysis doesn't work. I don't think that means the approach is broken when you buy breakouts, and sometimes this happens. It means you better have a good money management strategy. That's why we don't just blindly buy charts and ignore the risk involved. We have to think about potential reward, and we have to focus on potential risk. By the way, interview last week with Callum Thomas on the Market Misbehavior podcast. Really interesting discussion about risk. I would encourage you to check that one out as well. So the chart of Amazon is not great, and it's also not good. I would say at best it's okay. And I say it's okay because it's still holding the 200-day moving average. But given what I've seen on Friday and then giving the further deterioration today, I'm inclined to assume that this is the beginning of some further deterioration. The 200-day moving average is obviously incredibly important. I think as long as Amazon holds 210, that's still an okay chart. Is it the best chart I could show you? Absolutely not. And there are others that have not gapped a lower like this on an earnings miss. But I would say holding 210 would be pretty important. It breaks 210, and there's nothing really left from a technical perspective besides looking at downside targets and really thinking about further deterioration. So if you're a swing trader and you think I'm going to buy Amazon at the 200-day and bet on a bounce, I get the argument. That's not how I tend to trade, but and I probably would not take that shot. But I don't blame you if you would. If you would, I would just argue, please make sure you use good money management and clearly define your risk. All right, let's continue on. I'm long-winded today. I think this is a standard. I haven't measured the time I spend on sort of theoretical investment wisdom type of comments on Monday, but I bet it's more than normal, just because I've spent a weekend with my family not thinking about the markets usually, and so I come back with a lot to say. Before we continue, Tony, thank you 2 times for 2 very kind and generous super chats on YouTube. I appreciate that so much. It means a ton to me. I appreciate your kind words. Also, a little bit of education on the history of Switzerland, which I did not know. So thank you for the update on that, and thanks for the very kind words and the tip. I appreciate it very much. We are live streaming on Facebook, LinkedIn, YouTube, and X. Thank you so much if you're tuning in live. Please, anywhere where you can put a comment. Drop a question as we go. I'll grab a question or 2 at the end of the episode to answer. And if we don't get to it, we'll put it in the mailbag. We had a good mailbag episode on Friday. Check that one out as well if you missed it. Some good questions from all of you guys over the last week that I took a little bit more time to answer. All right. Let's continue on here. I mean, strong day for growth stocks for sure, right? And if you look, I mean, the big names in bright green jump out. You've got NVIDIA, Microsoft, Broadcom, Oracle, Alphabet, Meta, Tesla, all up over 2% today. That's a pretty strong day all around. And I think the strength in those names is really what's saving this market more than anything, right? I mean, think about what the market would look like without sort of the mega cap growth trade. I mean, it would still look good, but not this good, right? And I think what we found as Palantir is reporting earnings after the close here today and appears to be gapping higher. I mean, there are names like that are sort of the AI tech, growth space that just looks so remarkably strong. And that's why the action in like Meta and Microsoft Thursday and Friday really raised, perked up my contrarian, awareness, because it felt like there was something different maybe happening on here. Today, you're seeing a nice continuation in some of the rallies that we've seen in semiconductors with names like AMD popping after Friday's drop, KLAC, another semiconductor name popping higher. You can see a number of the other technology stocks doing quite well. Obviously, mega cap communication services looking quite well as well. We have Disney on the earnings list. They were, I want to say on Friday, right? Am I making? Oh, this Wednesday. I was going to say, I remember talking about it somewhere this week. Disney's an interesting chart because it just made a new 52-week high, and then it just pulled back. Friday, it gapped below the 50-day moving average. Today, back above. I think that's a crucial one. I do own Disney in my own portfolio, so we'll see what happens. See what happens there. Elsewhere in the market carpet, I mean, my general takeaway is, on a strong day like this, you see a lot of strength. So it's very clear, very obvious to look at some of the weakness. You can see Berkshire Hathaway down 3%. I actually, full disclosure, exited a position in Berkshire that I've had for quite some time. The break below the 200-day, the failed retest was enough for me. If I apply my market trend model to Berkshire Hathaway, it's bearish on the medium-term time frame. I've had enough. I left. So if it rallies from here, the Dave Keller contrarian indicator is alive and well. But I did exit that position because I often mention with individual stocks, I try to remember to disclose. I don't have a ton of individual stocks. I'm more of an ETF type of person in my portfolios, but Berkshire was one I'd owned for quite some time and sold off. It certainly feels, from a technical perspective, that it from the moment Warren Buffett announced his predecessor, or announced his successor, that is, the stock's been in a free fall essentially from a technical perspective. So that was enough for me. Elsewhere, you can see energy struggling, obviously, with crude oil prices coming up. Exxon and Chevron reported earnings, and both of those kind of rotating down here to start the week in a position of weakness. Other than that, some random names in red, but I would say generally this is a pretty strong start to the week. So now we have two competing themes, right? We have the, fearful reality that I think Thursday and Friday lit up for a lot of investors, right? Friday's jobs data really was a lot weaker than expected, restating the last two or revising the previous two results certainly weighed on the market aggressively. Today, we have a nice bounce higher. Here's the problem. It is very common after a huge sell-off to have a counter trend move higher. Technicians would call that a dead cat bounce, which is a horrible visual to describe a market that sells off, and then you often have this big spike higher. And it's called a dead cat bounce because the cat is not alive anymore, and that is the implication for the market. The way that you confirm that that's not the case and that things are getting better is you make it above the previous high, right? You make a new high on stronger momentum. I think when we see that, market's all clear. Until then, I'm inclined to think more cautious here, and the seasonality is what's getting me to as well here. All right, let's continue on and look at some charts here. The S&P 500, I have updated a lot of the lines. As I've mentioned a number of times, I treat the daily chart of the S&P 500 like an ongoing dialogue I have with the markets. I feel like this is my daily coffee talk with the markets, just thinking about what I'm seeing, reflecting on key levels and key patterns. And I've found when I feel compelled to start changing some of the annotations, that usually means there's a change of character happening, right? And I have changed some of the support levels and things just to reflect the fact that after Friday's gap lower, I feel like we need to start thinking about lines in the sand, right? We closed Friday below the 21-day EMA for the first time since April. Today, we did close back above that, and that's encouraging. But barring any big move above 6,400, which for me would be a beautiful all clear signal, I'm looking at some short-term support. 6,200 looks like an important short-term level. That was a couple swing lows from early July, and Friday's gap lower almost made it exactly down to 6,200. So that's kind of the initial level that I'm watching here in terms of specific support. Below that, I'm looking at a couple levels down in this kind of 5,900 to 6,050 range. The price gap from mid-June is right around 6,050. The swing low just before that is around 5,950, and the 200-day moving average is actually right around there as well. So starting to think that maybe that 5,950-ish range would be a reasonable downside target if we break through 6,200. So think of it as sort of an if-then statement. If we break here, we probably go down to some further levels. If we would break much further down from what we saw on Friday, I would use some things like Fibonacci retracements. The 38.2% level, by the way, is down here around 58.20. That would be a 38.2% retracement of the April to July rally. But again, I think it's too early to be thinking about downside targets too aggressive because we're still holding support in the short term. So let's keep an eye on that to start. Spreads. We've talked about how spreads, high yield spreads in particular, have remained very narrow. This basically means bond investors trading junk bonds are not seeing a lot of risks out there. That changed a lot at the end of last week. This is updated through Friday's close, and you can see that high yield spreads spiked higher. Still not at warning levels like you saw at the April low or that you saw back in 2023. But I think you can see that that spreads are starting to widen. So widening spreads, higher volatility tends to coincide with stocks going weaker. Now this is reported on a 1-day lag on stock chart, so I don't have Monday's data just yet. We'll see that tomorrow, and I wouldn't be surprised if it tightened up a bit because the VIX pulled back a little bit. But this is one of those kind of important charts to watch. I mentioned John Kosar talked about volatility. I would agree. I would add credit spreads on there as well because bond investors tend to be really good about recognizing potential risks and changing their positions as a result. We'll see. Here's the chart of the VIX just to show we did briefly go above 20 on Friday. Today we pulled back below 18, around 1750 at the close. Keep an eye on this chart because a push above 20 and staying above 20 would be definitely suggest a corrective move. For now, it's still okay as it dropped back below 20 today. Stocks above key moving averages. Here's the percent of stocks above their 50-day moving average in the S&P 500. As of Friday, it was almost exactly at 50. We're talking a coin flip that a random stock in the S&P was above or below its 50-day moving average. Today, bouncing up a bit, about 10% of the S&P, 5% of the S&P. That's the math. 5% of the S&P members bouncing, basically getting back above their 50-day moving average today. Let's see if this holds the 50% level, because again, that's when I think about what would tell me this is the beginning of a much deeper correction. Indicators like this breaking the 50% level would be one of those validations I would look for, because that tells you even if the S&P is holding up, even if the NASDAQ is holding up, a lot of individual members of those indexes are starting to struggle. It's not a warning sign just yet, but something I'd be looking for. I would say the NASDAQ bullish percent index, though, is already giving us some big time warning signs, because in mid-May, as the S&P is pushing, or excuse me, this is the NASDAQ composite pushing above 19,000. We're at 85% of the NASDAQ 100 above there with a bullish point and figure chart. As of Friday and through today, it's right around 50%. So that means 35% of the NASDAQ 100 stocks have had a bearish signal in their point and figure chart just in the last quarter, which means from mid-May to early August, as the S&P and the NASDAQ have been making new highs, more and more of these large growth names in the NASDAQ 100 have actually been generating sell signals. That's not a healthy breadth rating. That's a pretty dangerous breadth rating. And that's happening in the growth leadership that has been the story off of the April low. So I think the character of this market appears to be changing. And again, we'll see what happens. We talked about some levels to watch with the S&P, but the internals feel weaker to me. Gold overall still very much range bound. If you look at the chart of the GLD, I mean, the momentum is still good in that we're holding an RSI of 40, but you can see rallies. The RSI is kind of stalling out around 60. So very similar to the chart of Tesla. It's more consolidating, and you're waiting to see which way we break. I think the GLD above like 315, 317 would be a very bullish breakout and a bullish resolution to this sideways pattern we've seen since mid-April. A break below 300 on the GLD would suggest much further deterioration. I'm going to jot down some alerts here. 300. And so I think this is an important one to watch, sort of consolidating. I still have a decent gold position working right now because of the long-term strength, and I don't see enough weakness to really unwind those. I did sell a bit of the position. That's just because it had become so large last week. But overall, I'm watching the GLD to see if we resolve that pattern to the upside or not. Now, gold stocks are actually doing quite well today. And I mentioned Newmont Mining, one of the top performing S&P 500 members. Today, the GDX, which is a gold miner ETF, made a new 52-week high, actually a new all-time high today. So you're seeing a nice resumption to the upside on gold stocks, actually performing a little bit better than spot gold. Not quite a huge breakout just yet, but we'll continue to monitor that. But I would say gold stocks doing quite well. And I mentioned the Dow industry groups, gold miners, the top performing group. Meta, as we mentioned, I think a key chart to watch, just shared on Stock Charts TV. I don't think it's released yet, but I just earlier today recorded top 10 charts to watch for August. Meta is one of those 10, mainly because I think whether or not Meta holds 740 may be the key to understanding what's happening in this market. If Meta is able to hold 740 and resume an uptrend, there's just limited downside for the S&P and the NASDAQ because it's dominated by companies like this, huge mega cap names still doing quite well. On the other hand, though, if Meta does not hold 740, if it cannot hold this breakout after the ridiculously good quarter that it had, and the expectation that Meta is going to, threaten Apple and just overtake this whole AI thing, which is the energy I'm hearing around the company at the moment, can't hold 740 with that sort of optimism. I think that tells you everything you need to know about investor sentiment here in August and September. My gut would tell me that this is a failed breakout because of the weak seasonality and the skepticism that I'm seeing. But I'm a big fan of the market not caring what I think. Let's focus on the evidence and focus on the trend. I mentioned in a recent podcast, by the way, a therapist, a previous therapist of mine used to call that shoulding all over yourself. When you talk about what you should do as a person and what you should do in a relationship. And I would say we do the same thing with the market. We talk about what Meta should do because of XYZ. Don't do that. Don't should all over yourself. Focus on what the evidence that the market is providing back to us. Tesla threatening to break down here, testing the lower end of this consolidation pattern. I did put out a video last week on my YouTube channel focusing on this coil pattern for Tesla, thinking about potential upside and potential downside given the framework that pattern provides. I would encourage you to check that out because we're in a consolidation phase. We're in a sideways phase. Tesla currently testing the lower end. You can watch that video and get more details about sideways trend, sideways moving average, sideways momentum, and what we would need to see. Tesla below 300 is a pretty significant bearish rotation, I would argue. Now, there are charts that are working beautifully, and I would say monolithic power system, ticker MPower, looking pretty good here. Sorry, I got away from it. Here we go. Monolithic Power Systems is one of the semiconductor names. Semiconductor space, obviously a bellwether group in technology, and one of those groups that has tended to do quite well. Strength in semiconductors means there's optimism out there. It's just very focused on this particular sector, and sometimes I would say for now, the break above 775 that we saw on Friday, today continuing with the move higher, closing above 830, really is a strong chart getting stronger. I don't see anything to really not like about the chart of monolithic power systems, save the fact that we are nearing a confluence of resistance. So in terms of uptrend, that 925 to 950 range all of a sudden gets us back to the previous all-time highs. That's where I would probably start to be a little bit more skeptical, but overall, the short-term trend is quite positive. Palantir reporting earnings after the close today. Let's take a look at what happened. It looked when I was getting ready to go live here, it looked like Palantir was closing higher or was trading higher in the after hours. Yeah, up about 4% to 167 at this point. So we're making new all-time highs in the aftermarket. So I mean, this is obviously Palantir is an example of the types of companies that are thriving in this environment. What concerns me is about the market is not just these stocks, but these kind of stocks have done so well for so long. It's making the benchmarks look a lot better than they are. Look at the jobs data on Friday, which basically suggests the economy is slowing. Look at the behavior in non-technology sectors, and you will see that stocks are struggling in a lot of cases. But Palantir is still making new all-time highs. So it does tell you that owning stocks tied to these themes are still working great. And I don't see a reason to sell a company like this or a stock like this. If I did own it, I don't own Palantir individually, but if I did, I don't see anything on the chart telling me that this is anything but bullish, right? We're making higher highs and higher lows. We're above upward sloping moving averages. The momentum is strong, but not excessive. The relative strength is good. This has obviously been a very, very good chart. And off the April low, having recovered off of that sell-off, it's been lights out positive. So I assume a chart like this is innocent until proven guilty. Even if I'm bearish on the S&P because of seasonal weakness and whatever else I want to throw at you, as I sign off every episode, it's always a good time to own good charts. This is a good chart until proven otherwise. All right, let's take a question or two and be done. I'm not going to try to pronounce your handle, Clayters, I guess. Hey, Dave, do you ever use the rate of change for buying into a stock? Like if the rate of change is showing a bullish divergence with price? I mean, the short answer is no. I really don't do that. That's not to say it's not a good idea. I will tell you, I mean, I often get questions about specific indicators. And the reality is, this is something you learn, I think the longer you look at charts. I've described the life cycle of a technically oriented investor as having three general phases. The first phase is a very undisciplined, probably oversimplistic process where you feel like you just find this one thing and that's it. And then it works really well and you start putting money behind it. And then you get your face absolutely ripped off. And then you realize you need to learn more. That's the novice phase, right? And that's the Robin Hood crowd that hopefully you graduated out of. The intermediate form is where you start reading a ton of books, you start learning a ton, and all of a sudden you start creating charts with a bunch of stuff on them, a bunch of noise, it turns out. But you look at every indicator. And this is, I learned, I mean, there are very few technical indicators you would ask me about that I've not at least heard of or talked to someone who uses it. And that's what happens. But I think the problem is in that phase, you tend to overcomplicate and you tend to have all of these things with a lot of stuff, a lot of busy charts. Then you get to that expert phase, that third phase, which I hope you all get to, which is you start simplifying again. You actually go back to simple approaches, but they're ones that you've learned add value, right? It's a robust process, which when you're designing models, a robustness check means you want something that's going to work in different scenarios, not something that's just going to work, not a curve fitting back-tested approach that works perfect as long as conditions stay exactly the same. You want something that's going to work in different kind of environments. And so that's my peers in the industry that are now, we've been doing this for a couple decades, are all, I mean, our processes generally are pretty simplistic because we kind of find what we know, and you don't need to look at 8,000 indicators because you have the couple that really work for you. And I don't think you can just jump to that last phase. I think you need to kind of go through the motions and go through your own discovery process. So that's my long-winded way of saying rate of change is just something I'm familiar with it. I have used it. I would say where rate of change is super helpful, in my opinion, is mean reversion, right? Recognizing the fact that when you have big swings, in either way, you often have mean reversion to the other side. And so that's somewhere where I definitely use rate of change. I use rate of change in longer term scenarios, right? Look at a chart of the S&P 500 with like the 12-month rate of change, and you'll get some really interesting insights in terms of big picture secular shifts and what they look like. But do I use that? No. For that particular approach, thinking about bullish divergences and where price and momentum diverge, which is what you're asking about, I use RSI. Having said that, if you use rate of change and come up with a good approach, that could definitely work, and you could definitely make plenty of money using that. For me, RSI has been the one that I use. Thanks for asking about that, by the way. Let's take one more question. The World According to Ruben. Thanks for watching consistently, my friend, and thanks for your thoughtful questions over time. I'm going to look at CRDL. Not a stock that I look at regularly. I don't know a lot about this company, which is great. So I'm giving you a pure, unbiased technical view. I mean, the short answer is this is a good chart. What makes this a good chart, right? So, I mean, the initial assessment, it's a good chart. What makes it a good chart? Start from top to bottom. Think of it like a checklist. And this is literally the checklist that I use internally, but I used to write it out by hand as I was building out my process years ago. Starts with price. What is the trend doing? We're making higher highs and higher lows, right? These peaks and valleys in the price. The highs are getting higher. When we pull back, we're not pulling back as much. That's a stock in an accumulation phase, according to the way I describe it. Moving averages, what are they telling us? Well, we're pulling back to an ascending 21-day EMA. We really haven't broken it on a closing basis since the uptrend launched in mid-April. The moving averages are in the proper order. They're all sloping up. I think that's great. Any price patterns? I mean, not really. I don't think I would say. No, I don't think I would consider any particular price patterns. I'm jumping through my checklist randomly here. Momentum, what I call confirmation. What's the momentum telling us? The momentum overall is pretty good. We had a bit of a divergence here, but the RSI never really was, out of the overbought region on these peaks. So I think the momentum is still pretty strong. The relative strength is lights out excellent. I mean, this is a stock that's gaining much more than the benchmark. So this is one of those long and strong charts. Long and strong was just the general shorthand we would have of, think about a big pie. You print out a bunch of charts, which we literally used to do and kill so many trees. And again, I'm apologize for that nature for doing that back in the day, but that's what I was told to do. We printed out a ton of charts and we'd separate them into good, bad, and neutral. Then we take the good and separate it from really good to kind of good, and the bad from really bad to not so bad, and then the okay from things that might start improving to things that aren't. And that's how you started to take a portfolio or a watch list or a sector and started to differentiate the good from the bad, and then just build it from there. This is one that for me would go immediately in the good and then in the very good bucket, because it's showing all the signs of strength. At some point, it's going to top out, but I'm not seeing anything on the chart that would have me concerned at this particular moment. Long and strong. That's what we would call that top bucket. Great question, by the way. Thanks for asking about tickers. Thanks for asking about indicators. I appreciate it. I didn't get to all the questions that you asked about in the episode today, but I will put them into the mailbag. We did an all mailbag episode on Friday. We're planning another one this coming Friday. Otherwise, should be a normal week in terms of the show. So thanks for tuning in live if you're doing so. If you're watching the replay on our YouTube channel, questions are always welcome. Just drop a comment below the video with your question. Thanks again for the tips today, Tony, and thanks for being a longtime watcher and supporter of the channel. I appreciate it so much. It means a ton. For Market Misbehavior, I'm Dave Keller. Have a great evening, and remember, it's always a good time to own good charts. Have a good night, folks.